It's been a red-hot year for IPOs. Investors have been flooding into these stocks with a handful surging triple digits since their IPO. Beyond Meat leading the pack here, up over 500% since going public. And it doesn't look like the IPO frenzy is about to stop. Bob Pisani is at the NYSE to break it all down. Hey, Bob.
Hello, Melissa. 7 this week are coming. We've had 66 IPOs so far this year. They've raised $26.7 billion. That is a very strong first half showing, considering the IPO market was not even open in the first 2 months of the year due to the government shutdown. So incredible returns here. It's the overall returns that are impressive. So look here. 57% of those 66 IPOs are trading above their IPO price. That's fairly typical, but look at this. The average return so far this year is 22%, way above average, and the average first-day pop is 28%. Heavens, that is way above a typical number. So what exactly is going on? The companies doing best, the ones that are really popping, are high-growth companies. So we saw Beyond Meat, we saw Zoom, we saw PagerDuty. They've had triple-digit gains. Pinterest, TradeWeb, they're up over 40%, all very high growth. But even the 3 IPOs from last week, Chewy, Fiverr, and particularly CrowdStrike, they've had huge gains in a few days, and all 3 are in different spaces, so you can't say, oh, it's just cybersecurity. Everything is popping that has any growth. We'll see what happens when we get these 7 more IPOs this week. Plus Slack via a direct listing. Not really an IPO, but we're sort of counting it that way. Not all high-growth IPOs have been the winners. The obvious ones, Uber and Lyft. Uber number 1 for the year in terms of money raised, and Lyft number 3 in terms of the money raised. Still down. Uber's closing the gap a little bit. What do they lack that the others have? Well, right now, investors are not impressed with the economics of ride-hailing, specifically the deep losses they've seen there. In addition, both suffered from valuation issues. Remember, neither of them have had a successfully publicly traded peer you can compare them against, and both priced well above their last round of funding. So they're off on a little category by their own. Back to you, Melissa.
All right, Bob, thank you. Bob Pisani. Well, our next guest says if history is any indication, the IPO mania could actually spell trouble for stocks. Noah Weisberger is the head of U.S. portfolio strategy at Bernstein. Noah, great to have you with us.
Thank you very much.
And you actually found that there's a relationship between the number of IPOs that go out in earnings?
Between returns, forward returns. So what we found going back 30 years is that peaks in IPO activity tend to be correlated with more muted forward returns. So not negative returns, but a bit of a headwind to the market. And in interpreting that, I'm not sure if it's that the IPOs are just too much supply for the market to take down, or if it's that corporates are kind of clever, and when they time the IPOs and they do it after the market's rallied, when multiples are at a premium, is it causing one or the other? I don't know that we have an answer, but it is an interesting and kind of a consistent historical pattern.
So what we've seen so far in terms of the flood of IPOs, does that make you concerned about forward returns, and how far out would you be concerned about?
Right. So I would say 2 things. First, the wave of activity we've seen in the IPO market is still really modest compared to some of the big booms we've seen, certainly in the late 90s, but even in the 2000s. The entire post-Great Financial Crisis period, the run rate of activity has been pretty muted. And 2016, when we saw economic activity pick up, that's usually correlated with IPO activity. It didn't happen. So it could be that we just have been waiting for some of this to come to market, and it looks like it's a big flush of activity, but it really isn't. And so I'm not sure exactly how worried we would be just on the activity alone. That said, I think it does dovetail with our broader set of market views, which is, look, we have a 2950 target for the end of this year. That's not a lot of headroom. And I think it just goes to speak to the fact that, what's the optimism, what's getting you excited about stocks here? Even the IPO market tells you, things are getting a little bit old and long in the tooth.
No, we just spent 10 minutes at the top of the show debating the S&P 500 at 16.5 times, whether it was cheap, or what the deal was. Now you have all these issues coming out in such a crowded fashion at really crazy valuations with no real earnings per se, if you take the whole lot of them. Does it make you worried that we're having a flush of these very expensive names at high valuations, and then 6 months from now, we're going to have tons more stock, because we know most of these had very small floats?
Right. So I think what's interesting on the valuation front is that, on the one hand, I would argue that valuations probably at the index level start to compress from here because a lot of the accelerants, the margin growth doesn't exist anymore. We think earnings should be slowing, and that usually means a bit of multiple compression. That said, where we're less worried are some of these growth names. And so as economic growth slows at this point in the cycle, we think there should be a premium for quality growers and quality compounders. We think idiosyncratic growth is something that gets rewarded late in the cycle. And in the context of the current cycle, if the Fed is going to cut or not, but with interest rates where they are, be patient. There's no reason for you to be worried about long-term growth views. Maybe there's a hiccup in the middle, but at 210 on the 10-year yield, what's the duration risk you're worried about? So I'm burning the candle at both ends. I think multiples compress at the index level, but I'm not really worried that you're paying a very high multiple from a levels perspective for a long-term growth story.
Noah, thanks so much for coming by. It's fascinating stuff.
Great, my pleasure.
Karen, what do you think?
I don't know. I sort of feel like they're, seeing markets react as they have to the last few that have just gone berserk, that the private equity is just rushing as quickly as they possibly can to get anything out the door. So I'm a little concerned about quality control going forward.
Quality control specifically for the IPOs, but in terms of what it might mean for the markets?
Well, not what it might mean for the market,
Okay.
just in terms of like, are they, do they see this as they normally wouldn't have this option open at all, now they might, and just shove anything out the door.
Right. Pete?
Noah talked about quality and growth and
Yeah.
all the rest of that. I totally agree. I mean, that's what you're talking about. You mentioned at the top of the show, selective. You pick around, you look around, you find quality with growth, and I think you've got a great combination there. But this IPO market, I think something that speaks to me is you look at Lyft, you look at everybody was waiting for that in Uber, right? I mean, that was the excitement, I think, of all the names of the two biggest. And then you look at where they are and what they've done since the IPO. I think it says a lot because I think people are being a little bit more careful about overpaying for some of these names that don't have any earnings. They don't make money yet. I mean, those I think are problems that exist for some of these names that are going to persist for years. That's a real problem for me.